Welcome back. We have discussed about the net present value in the previous section of our discussion. In the net present value, one more thing, let me explain you. We learned about how to calculate the net present value in the spreadsheet. And we have seen here the net present value function we used, and we have calculated for three different projects the net present value using the different cost of capital and discount factor, and also different kind of cash outflows and cash inflows. Now there is another kind of situation might arise. Here you can see the example here. You see the cash outflow is 50,000 on 23rd of February 2018. You can see here 24th of August 2018 you have an inflow of 14,000. 5th of March 2019 8,000. 2nd of November 2019 23,000. 5th June 18,000 2020. 18th December 2020 19,000. So cash inflows are in different point of time. In the spreadsheet, when we are entering the data, we assume that, means spreadsheet assumes that the cash inflows are year wise. Yearly, if it is given the cash flow after the cash outflow, whatever is there, it assumes it is cash inflow after 1 year. Next one after 2 year. Next one after 3 year. After 4 year. After 5 year. Like this, the command is given to a spreadsheet, and spreadsheet assumes that. But what happens? The cash flows are not yearly. It's not in a particular time. There is no kind of pattern fixed there. Time pattern is very kind of haphazard. You got some one amount you spent right now in February. Same year, August, you got an inflow. Next year, March, you got next inflow. Next year, 11, November, you got next inflow. So the cash flows are not yearly. There is no specific pattern in the cash flow timing. In that case, what happens? You can calculate the NPV not by the normal NPV function. You have to use the X NPV function. You see, there is an X NPV function. If you use this, you can simply you can use the rate. After that, rate is 11%. Then comma. Then values. Values are the cash flows. Enter all cash flows. There is no inflow outflow here because the spreadsheet assumes here the spreadsheet will assume that the cash flows and cash flows are evenly distributed, so it will calculate accordingly. And next is the time frame when you get the cash flows. Enter. This will be the way. If you have unevenly distributed cash flows, you can calculate the NPV in this way. Next we will see payback period. Payback period is the simplest method of capital budgeting technique. Here we simply see how long it will take to get back your money, or how many years the project will take to pay you back your initial investment. So the definition itself is very clear. Payback period is nothing but the number of years to recover your initial cost or initial investment. So acceptance criteria. Before coming to the acceptance criteria, let me give an example to you. For example, you invest 10,000. Right now, initial investment is 10,000 minus. Your cash flows will be 5,000 per year for 4 years. What is the payback period? Simple, because your initial investment is 10,000 and your cash inflow per year is 5,000. So in 2 years, you calculate the cumulative cash flows. In the end of first year, you will get 5,000. End of second year, you get 10,000, which is your initial investment. Therefore, the payback period is 2 years. Another example, you invest 10,000 and your first year you are getting 4,000, second year 4,000, third year 4,000, fourth year 4,000. What is your payback period? End of first year you get 4,000, end of second year you get 8,000, end of third year you get 12,000. That means 2.5 years is the payback period. You need 10,000 to be recovered. So after 2 years, you get 8,000. Remain to recover is 2,000 because your total investment 10,000. You recovered 8,000 in 2 years. Next, in the third year, you get 4,000. You need only 2,000. That means half of third year, 2.5 years is the payback period. Like that, we calculate when we will get back our money. Spend 15,000 and get 7,500 per year. That means 2 years is the payback period. So it can be round years or it can be proportionate years. Minimum acceptance criteria set by the management. Your payback period must be less than that criteria. If the management gives a criteria of 3 years, so any project which is less than 3 years payback period is good, because management wants the initial investment must be recovered in 3 years. Their criteria is 3 years. Your project, for example, 10,000 and you get 5,000 each year for 4 years. That means payback period is 2 years here. Management give criteria 3 years. Your payback is less than the management criteria. Good. You should accept. For example, management gives a criteria of 3 years and your project is, for example, 20,000 and you get 5,000 for 10 years. So 20,000 to recover, 5,000 per year will take 4 years payback period. But management gives criteria of 3 years. So the project payback is more than the management criteria. So reject, because management wants to recover in 3 years. Criteria is 3 years. And your project is giving payback of 4 years. So more than the criteria means rejected. Ranking criteria set by the management again. So how to rank to the multiple projects on the basis of payback period, the management gives the criteria. Here, disadvantage of payback periods. This is a very simple method, but there are so many drawbacks are there for this method. What are they? It ignores the time value of money. Simply, we are taking the cash flows as it is after 1 year, 2 year, 3 year. But we are not taking the cut-off rate or minimum cost of capital or time value of money. We don't consider. That's why it's a not scientific method. It ignores the cash flows after the payback period. Yeah. Before, just example, I said 20,000 is the investment, 5,000 cash inflow for 10 years. But management's criteria is 3 years payback. Must be the management maximum criteria is 3 years. This project is payback period 4 years. You reject. But you never considered the project's total life. It gives you 10 years. 5,000 multiplied by 10 means 50,000. You're only investing 20,000. You're getting 10 years and total cash flow of 50,000. You are not considering. You are just simply saying payback period less than the management criteria, accept. Payback period more than a management criteria, reject. No further thing. What happens after the payback period? You are not bothering for that, which is not a good thing. Biased against long-term projects, for the long-term projects, this might not be a good method. Requires an arbitrary acceptance criteria. How the management will say 3 years is the criteria set by the management is totally arbitrary, not scientific. A project accepted based on payback criteria may not have positive NPV. So you might be taking or accepting a project on payback period. The management set a criteria of 2-3 years. If the project is less than that, you just accept, but it might not be giving you positive NPV. Be careful, because you don't use the time value of money. Advantages. Every coin has a second side, The advantages of this method is it's easy to understand, biased towards liquidity. How fast you can recover your money is the criteria here. Therefore, it is biased towards liquidity, and definitely it's good for the business. Is the disadvantage of payback period we have seen the first one, and the most important one is it ignores the time value of money. The third method is discounted payback period. The discounted payback period method considers the problem of time value of money. It considers here the time value of money is considered in the discounted payback period. It is same like payback period along with time value of money. How long your project will take to pay back the initial investment, taking the time value of money into account. Decision rule: accept the project if payback period on discounted basis within the specific time or within the management criteria. By the time you have discounted the cash flows, you might as well calculate the NPV also, isn't it? Because time value you are calculating, so at the same time you can calculate the NPV also. Let us see how it is done. Here, for example, there is a project here. Same project which is being considered here. 30,000 minus 8,000 first year cash inflow, 10,000 second year, 11 third year, 17,000 fourth year, and 12,000 fifth year. Now, management criteria is 3 years. How to calculate the payback period? How to calculate the payback period? I'm just explaining here. You see, as I said, payback period talks about the cumulative cash flows. So first of all, we will take the cumulative cash flow. First one, cumulative cash flow. First year, the cumulative cash flow is minus 30,000. Second year, how much? Is equal to first year cash flow plus 0 year cash flow, initial cash flow plus whatever you got in the first year, that will be added to get the cumulative cash flow. And the second year cumulative cash flow is equal to the total you are getting up to first year plus second year's cash inflow. And third year cumulative cash flow is equal to whatever you got up to second year plus the fourth year's third year's cash inflow. And the fourth year's cumulative cash flow is equal to how much you have received up to third year plus fourth year's cash inflow, 17,000. And the cumulative cash flow of fifth year is equal to how much you have received up to fourth year plus the fifth year's cash inflow. Like this, you calculate the payback period. Now what happens? We need to see 0. Whenever it becomes 0, you have collected fully. You see, in the 0 year, you spend 30,000. Always it is negative because it is initial investment right now, 0. First year, out of 30,000, you could recover 8,000. So still negative is 22,000. Second year, you could recover 18,000 out of 30. Still 12,000 is negative. Third year, you could recover 29,000 out of 30,000. So 1,000 is still negative. So the payback period is somewhere third year and fourth year, because fourth year you got a surplus of 16,000, all recovered. Therefore, the payback period is somewhere third and fourth year, in between the payback period is there. There is a method we can use to calculate the payback period. How? Let me explain you here how we do that. You see here is equal to, there is no like direct function available in the spreadsheet, but we can use some indirect functions or some kind of combinations. How? We can put a if and statement. So there is a if statement, put it. Then we can add and, so that there will be specific if and the initial cumulative cash flow, initial investment is always less than 0 because this is the initial investment, so less than 0. Then what we will do, the next year, which is always which should be greater than or is equal to 0. If it is true, then what will happen? The previous year will be the previous will be the year will be the payback period plus there is a function called ABS, absolute value. The C22 is divided by the cash inflow of the same year, 11, 8,000. C11 is 8,000. If it is not true, then you give me zero value. Okay, let me enter. You see, it came 0. It came as 0. Let me put it number, so it will be 0. Yeah. Put this down, Control D. You see here, the payback period is 3.06 years. How it happened? 0 year is not the payback period. Why? We have 30,000 not recovered. First year also not the payback period. Why? Still 22,000 not recovered. Second year also not payback period. Still 12,000 not recovered. See 0, 0 it is showing. Third year still not the payback period. Still 1,000 is not recovered. Where is the payback period? 3 and 4 in between. So I have taken the third year plus absolute value of the cumulative cash flow of the same year divided by cash inflow of the same year. That is equal to 0.06. So the payback period stays in between third and fourth year. Because in the third year, the payback period was 1,000 not recovered. You see here, 1,000 not recovered. In the fourth year, 16,000 excess recovered. So in between 3 and 4 years. How to calculate that? Using a if and statement, you can calculate the payback period. Or else what you have to do? You have to calculate like this. 30,000 not recovered next year. 22 not recovered next year. 12 not recovered next year. 1 not recovered next year. 16 excess recovered. So the payback period is equal to 3 years plus 3 years plus the absolute value of not recovered. Absolute value of amount not recovered in the 3 years divided by the cash flow you recovered in the third 3 year, bracket close, enter. See 3.06 years. Understand? Either you can calculate like this or you can calculate like this. This is, you need not do manually, you need not go and check. You simply if and statement you can add and make it. It is there available in the spreadsheet to be provided where you can make the practice. This is the way the payback period is being calculated. Now let us calculate the discounted payback period. In the discounted payback period, what we do? Simply, you see here discounted payback period. The same question, minus 30,000 and 8,000, 10, 11, 17 and 12,000, 1 to 5 years. Required rate of return is 10%. The maximum period set by the criteria, management criteria is 3.5 years. What you can do? The present values you can calculate. The present values you can calculate. The 0 year present value is equal to 0 year. 30 is equal to 30. The first year is equal to present value calculation. You know, time value of money is equal to present value function cost of capital, that is equal to rate 10%, and we need to freeze it further down. So F4 comma, it's asking the PMT. PMT is 8,000 for which you are doing, comma, future value. PMT, no in between PMT. Future value is 8,000 for which you are calculating the present value. Enter. Right? Yeah. So you can calculate the present value using the present value functions. So how to do it? Use the F2. The cost of capital, that is equal to 10%. Then how much is your cash flow requirement, that is the discounted cash flow, how much is the requirement, that is shown in the B22. And next is payment, you are not making any initial payment, so just put comma, Excel will take it. Future cash flow is equal to 8,000. Enter. Similarly, you can do it for, understand, again I'm explaining, okay? Present value, rate is equal to 10%, freeze it, comma. Which period you are getting this? You are getting this in the first year, comma. Payment, there is no in between payment. Excel will understand once you put blank and comma, there is no payment. Future value for which you are calculating 8,000, bracket close, enter. And the same you can down, Control D, and just go through the number format, put it number. So this is the way we can calculate the discounted cash flows. What is the difference between payback period and discounted payback period? In the payback period, we calculated 8,000, 10,000 as it is. In discounted payback period, we calculated the time value of money. After 1 year, today is 7272. 10,000 after 2 years, today is 8264. 11,000 after 3 years, today is 8264. And 17,000 after 3 years, today value 11,000. And last one, 12,000 after 5 years is equal to 7451, today's value. Then, right? Now, how we check it? Calculate the cumulative cash flow. First year, as it is, 30,000. Zero initial investment is 30,000, as it is. After 1 year, 30,000 minus 7272 is equal to 22,727. Same like payback period. Second year cumulative cash flow is 14,462. 22,727 plus 8,264 is equal to 14. Third year cumulative cash flow is equal to cumulative cash flow second year plus third year's cash flow, 8264, 6193. Fourth year positive, that means third year negative, fourth year positive. In between the payback period is there. Same like if and statement we will add, and we will get the 3.53 is the discounted payback. So you understand the only difference between payback period and discounted payback period is in the discounted payback period we consider the time value of cash inflows, which is given here. And the other things same like payback period. So this is the way we calculate the discounted payback period. I'll stop the recording here.